Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching.
Let's discuss some bearish type of trades you can do if you still feel like this market is going lower, right? Because just because we're up today doesn't mean we're not going to be lower tomorrow or lower on Friday. So if you are feeling like, February is going to be a down month as well, and maybe you're feeling this year is going to be a down year, and you want to create some bearish type of trades, and I'm going to give you a few ideas here. Excuse me. So for example purposes, I'm just going to give you some broad market ideas. You can use these same kind of ideas on individual stocks that you are interested in shorting. I'm just giving you strategies that you can use. So if we go over here and let's say we're looking to do a you're looking to be bearish. Well, you can be bearish in a number of different ways. So for example, if we went to this SPY, this is the S&P 500 ETF index, and if I wanted to be bearish here, I could buy a put spread at or near at the money line. So in this case, if I bought this put spread and I went, let's just say 5 points down, this is 51 days. You can do this longer, and I'll show an example of that. So if I bought this put spread, it's going to cost me $180, and I have the potential to make up to $320. So the most I can lose on what I pay is the 100 and in this case right now it's jumping all around. I should lock this so that it won't jump around for us. So if I paid 180, then that's the most I can lose on this type of put spread. If it goes down, this is how I'm going to make money if it goes down. So this is how it looks on the curve view really quickly. You need it. It's a 50-50 shot basically. If it goes up, you're going to lose. This is the loss zone. If it goes down, that's how you can win, as you can see here. Usually when we're doing these type of put spreads, if we're down 50% from what we receive, so if you're down $90 here, then you would get out of the trade because the directional play did not play out. Okay, so that's one way you can do it. You can buy a put spread. You can also, and I'm going to jump over here to the QQQ. This is the NASDAQ 100.
O'Brien?
Yes.
O'Brien, I just want to interrupt for a second. When you're doing one of these put spreads, are you also looking at like the volatility, the VIX, because it's so high that makes a better type trade right now?
So not necessarily, right? So you have to have the assumption that the market is going to continue to go down, because volatility being high is better for the option seller. And I'm going to show you some bearish positions for the option seller as well, because volatility will go back down to its norm. When volatility is low, then it's better for the buyer, because then volatility can spike up, and that means a bigger move is happening, and that helps you with that purchase. But right now, the assumption based on buying a put spread, and now I'm going to show you buying a put, you're assuming that things are going to continue to go down regardless of volatility. You think volatility is high right now, but it's going higher. So let's just say, for example, this VIX over here is now, it's down today, but it's at 29. You think it's going back to 40, or you think it's going higher than 40, something like that, DeVell. Okay, but normally it's better to buy when volatility is lower, or when it's been a really big move in one direction. So for example, I sent out yesterday some trade ideas. A lot of it was bullish or neutral, because I felt like the market has already dropped so much. It's hard for me to be bearish at that time when we've dropped so much, at least short term, right? But you can have a different assumption, and this is the kind of information I'm trying to provide here. If you have a different assumption that you think it's going down more, then you want to do some bearish type of trades, or you can look at individual stocks, DeVille, and you can use these type of strategies that I'm pointing out. Okay. Right.
Okay. But what I
So
was kind of leading to and what you answered, thank you, is that if volatility is high and dropping, it sounds like you're saying it's better for the seller to be a seller of the call spread. And if it's low volatility and you still think it's going to go down, then you want to go and buy a put spread. Did I say that
that,
right?
oh, exactly, a put or a put spread. Exactly. I would be the purchaser in that
Okay.
example, but it doesn't. Nothing is absolute.
Right,
Devel
right.
and everyone else, you could still be the purchaser now. Okay, so if I was looking at this Nasdaq 100 ETF, this QQQ, very popular, probably the second most popular ETF after the SPY that we just showed. If I was going to buy this one, I would buy at the money or a little in the money because you want to have at least a 50-50 shot of winning, and that's the best probability you can have as the buyer. So you want to be a little in the money or at the money. So in this case, if I was buying this and I lock this in, this would cost me 1638 to purchase, and I would have the ability to make all the way to zero. Obviously, this index is not going to zero, but this will give you a little bigger pop because it's not a spread if things continue to fall. But it's already fallen over 10%. Last night the Nasdaq was down like to 13,800 or something like that at one point. But this is the same kind of concept, everyone. You can see that at expiration, you needed to go down 16 points, 1638, almost 17 points you need to go down. But that doesn't mean you can't win in between expiration, but you want it to go down. If it goes down, that's how you win. If it goes up, you're going to lose right away, as you can see from this at the money line here, this line I'm putting. Okay? But this is, yes.
I was confused by DeVille's question and your answer. I thought his question was if volatility is falling, not if the underlying is falling.
No, so his question, unless I heard it wrong, and I don't think because he said I answered it. He said if volatility is high, is it better to be the buyer, or should you be the seller at that time? So I told him that it's better to be the seller when volatility is high because it's going to go back to the mean, and it's better to be the buyer if volatility is low, but because you can get that big expansion in volatility, which will help with the purchase that you did. But that doesn't necessarily mean, once again, everything is absolute, but that's in the ideal world, that's how you want to play it. So in this case, I'm going to show some examples in a second to be the seller of being bearish. Okay.
Okay.
You're welcome, Rob. All right, so this is the buying of the put spread, everyone. It's bearish. If the most you can lose is what you pay. But once again, I would get out of this if I'm down 50% because that directional play did not play out. But now if we go to the SPX, this is the S&P 500 cash settled index, and I'm just going to do the same. Just give you an example. Excuse me, and I don't want to hit that. Let me get this here. All right, I'm just going to go to 50 days here. So we've been looking at 50 and 51 days for the most part. So now if I'm going to sell a call spread, and I'm just going to give you an example here on the SPX. If I sell a call spread, I just say I wanted to. I feel like we're going to be bearish. We're going to go down, or volatility is going to go down. So I'm going to go and I say I sell this 15 delta here, and let's say I get a little bit more aggressive and I decide I'm going to do a 20-point wide, usually the widest type of spread we want to do on stock type of options, this is a stock option. So if we did this here, we would get 330. Let me lock this in really quickly on this mid. We would get 330 credit, and the buying power effect, as you can see here, would be 1660. Okay, so that's how much you could potentially lose when you're doing regular T margin. They're gonna require you to put up basically your max loss. This is a little off here, but you get the point. So you got the It's 20 points wide, so you got the 2,000 minus the 330. So your max loss is actually this, as this is saying. So usually this should match up, and it's not matching up for some reason, but that's your max. That should be your max loss. So if you take the 330 and you divide it by the 1670, that will be 19.7% return on your capital. So this still works for us. It's one of those times that this call spread would work. Yes, you can lose a decent amount, but this is if you're betting that it's actually going to go down and you're giving yourself a little room to be wrong if it jumps back up. As you can see here, this is the at the money line. It can go up and you can still win, as you can see there. And then obviously if it goes down, you're going to win 100% of the time if that's the case. Okay. So this is the call spread. This will work in volatility if it goes up some, but not a lot, and you can still win. If volatility comes out of the market, you can still win. So this is a play saying, okay, the market might go up some and volatility comes down, or it goes down, but it goes down at a slower pace. Then volatility is going to come out of the market as well. So this is the type of play DeVale I would use on when volatility is very high the way it is right now. Doesn't mean you can't buy. It's just if you're just thinking about a probability thing in volatility, you know, if it's just going to expand more or not. I think it's not. That doesn't mean it won't go higher. I'm just saying in 50 days, I think the volatility is going to be lower than 29 right now, this VIX here. All right, so the next type of trade that you can do is, and I'm showing a lot of indexes here. If you did the same kind of trade in the ES 51 days, and I just say I'm going to go, that was about 330. We're not going to go to 330. We're going to go something further away. So let's just say you wanted to do a 7 delta with 51 days to go, right? So, and I just do a 40-point wide spread here. So if you did this type of trade here, you would, and I'm going to lock this in here. You would get, if you get filled at this mid here, that's 113. You get $113 over basically $600, just under $600. So that's way more than 12%. And the S&P would have to go back to basically its all-time high. That's very close to its all-time. Let's see what that was here. So the all-time high was 48.08, as you can see right here. So it would have to go back to its all-time high before and it still wouldn't go past its all-time high for it to even hit this strike. So this is a really good trade, and I like to do it on futures so you can be so much further away. So if I did this 48.40, and I'm just doing a percentage from at the money, 48.40 minus the 43.96 divided by 43.96. This is just a percentage formula. This is 10% away. So the market basically, the S&P 500 would basically have to go. It had to erase all the losses because it was down 10%. It's not anymore. It's around 9% or something like that. It would have to go up another 10 before it can even touch your strike here. So I like this trade. All right, so that's one you can do. You can also look for a naked position, right? Being the seller, you can look to sell something naked. And obviously, if I'm going to sell something naked, I'm going to sell it really far away. And it has to meet your criteria of being at least 12% return on your capital and so forth. So if it doesn't meet that, then you shouldn't do it. But let me just give you an example. So I'm looking over here and I'm trying to see if I can go to some really, really low delta. So let me see here. If I went to just for example purposes here, if I went to this delta here, it's this 2 delta, 17,700. And if I did the mid here, you can see that this is requiring a lot of buying power, unfortunately, right? So, but yours might not. It might still meet the requirement. So this is requiring a lot of buying power in this account. So I wouldn't do it for that amount of buying power because it's not meeting your requirement. You could do something, what we call a synthetic type of short, and you just buy something really far away and see if that reduces the buying power. So for example, let's say I bought this here. So that reduced the buying power significantly, but it's still not giving me what I want. So I wouldn't do this trade, but this is trying to show you how you can do a naked position. All right, so the next thing I want to show is to be short. Let's say you believe this market is going down and you want to use a micro future to do it, right? To kind of benefit from it going down. So you can sell a micro future, and I'm just using this NASDAQ one here for example purpose. You can sell it outright, and that's it, right? And that's right now in this account, it's going to require about $2,000 in buying power to sell this short, right? And you're going to make $2 a point on this NASDAQ one. As it goes down, you'll lose $2 a point if it goes up. But let's just say we were using 50 to 51 days. Now let's say you want to do this, but you want to marry it with a call so that if it goes up, you're limiting your losses to the upside on this directional play by buying the call. So if we went here and we bought a call with 51 days ago, because let's say you think the market is going down for the next 50 days or whatever, 51 days. So if we went here, normally we hedge at a 30 delta. So let's just say we decided that we were going to buy at this 30 delta here. So if we bought at this 30 delta, then you'll see that this cut the buying power effect in half. It cut it in half here. But this 30 delta means this micro future means it's moving 1 point or 100. Okay, it's moving per every point. It's moving it's making exactly the amount that you should make, right? So this micro future is $2 a point. So every point you're making or losing $2. So it's a 1 delta or 100 delta. If you buy this option, this is a 30 delta. So you'll subtract 30 from there. So basically you're making 70% of the $2 if it's going down, okay? Or losing 70% of the dollar if it's going up. Well, if you can change this, dynamic by buying a bigger delta option. So for example purposes, let's say we decided we were going to buy the 45 delta option. Keep this in mind. This is about $1,000 that it's requiring, almost $1,100 is required. So if we go up here and we decide, okay, well, we're going to buy the 45 delta, right? So we're making basically 55 cents for every dollar move. If we buy the 45 delta, let me find it here really quickly here. If I bought this here, then you can see this changes the buying power effect completely, right? So this becomes almost insignificant, $311. So we went from like $2,000 to $311. Obviously, you're going to make a little less as it goes down, but you'll lose a lot less as it goes up, okay? And then once it hits this strike price here, you'll stop losing completely to the upside.